Although some of the same precursors of the 2008-2009 financial crisis are repeating today, AM Best believes the life annuity industry is much more resilient than a decade ago and well positioned to navigate future challenges. I'm John Weber for AM Best TV. Here to discuss a new AM Best report on this topic is Ken Johnson, Senior Director, and Thomas Rosendale, Director. And Ken, hard to believe it's been over a decade since the last financial crisis,
Yep.
But the report notes that some of the same conditions that were in place prior to this last crisis are in place now. Can you discuss the economic climate and the life annuity market in the run-up to the crisis?
One of the common threads we saw was we did have a very strong equity market going on right before the financial crisis. In addition, there was a lot of hope that interest rates were going to push off of a historic low, and the credit environment itself was also very benign. Pundits at the time were warning about a potential equity correction. They were concerned about a downturn in the credit environment and actually a flat yield curve, which often is a precursor to a recessionary environment. So we had the 10-year running along at about 5% at the time. We actually did have an inverted curve in '06 for quite some time, where in '07 it did start to turn around, actually wind up to about 99 basis points, primarily because of a big drop in short-term rates. We had some volatility from a global standpoint driven by oil prices, which were very volatile also leading up to the crisis from that standpoint. The S&P returned about 13.5% in '06, but then it did fall in '07 slightly, middle single digits. And then finally in '08, as we all know, it dropped about 36%.
So on the product side, running up to the financial crisis, we saw a bit of an arms race going on relative to now. Annuity sales were higher then, individual annuity sales higher in 2008 than they are now, even with a bit of a run-up that we had last year. Life sales were just as high as they are now, but the mix was significantly higher in risk. On the life side, you had secondary guarantee universal life products, no-lapse guarantee products that really dominated a lot of the life sales. Low premiums, priced to really not recognize fully the lower for longer investment environment that we're in, or the lapse experience that they were likely to realize over time. On the variable annuity side, variable annuities accounted for the lion's share of individual annuity sales, and many of them were sold with very generous secondary guarantee benefits, guaranteed minimum withdrawal benefits, GMIB, GMAB benefits. Again, very interest sensitive, very equity sensitive, and so there was quite a bit of potential for volatility. On top of that, of course, this is before a lot of players exited the long-term care market, so you had a lot of legacy long-term care business being put on the books at that point. Again, not fully recognizing the interest rate environment, not fully recognizing the lapse experience that they were likely to realize over time, and not fully understanding policyholder behavior and the types of utilization and the extent of utilization on the long-term care products. So so sales were at or above where they are now, and risk was running high on the product side.
Looking at the industry's response to the crisis, what is the biggest difference in asset allocation of life annuity writers as compared to a decade ago?
It's a great question, John, because I think on a very macro level, it's very hard to detect much of a change. If you look at the broad market, bonds will always represent about 70 to 75% of the portfolio. Commercial mortgages will always fall somewhere between 10 and 15%, and BA, or sort of the non-traditional assets, will run somewhere between 3 and 5% of portfolios. However, if you go a little bit below the surface, you can start to see some changes there, right? So we have the corporate bond market probably has grown from about $2.5 trillion to closer to $5.5 trillion since the crisis. But what we also saw within that growth, most of that, maybe $5 trillion of that, is investment grade, but there's been a large shift into what we would call NAIC 2 or BBB bonds. And a lot of that has to do because the market itself, from an issuer standpoint, the supply is much more heavily weighted to BBB. But the second piece of that is insurers trying to garner a little additional yield by going into a little bit lower credit quality while still remaining investment grade. So we've seen NAIC 2s grow from low to mid-20s to probably mid-30s, where we have some companies well over 50% at this point. A second piece of that is sort of selling more liquidity into the market. So what that means is on the private placement side. The allocation of private placements is up significantly, almost on the same magnitude, where it's come from low to mid-20s to probably mid-30s at this point. So probably a little less liquidity, again, in an effort to garner a little additional yield without sacrificing too much credit quality. If we look at it from a structured standpoint, back pre-crisis, most of the holdings were in RMBS, residential mortgages, or CMBS, commercial mortgage holdings. Today, it's probably much more in the collateralized loan obligations, or known as CLOs. But we're also seeing some combo notes where it's just restructuring of a structure. But what that does is allow some capital arbitrage by companies by combining some higher grade and lower grade securities in order to garner an investment grade holding. So again, it's more of a capital play, and we do watch for that as well. As I mentioned a little bit about the Schedule BA and the non-traditional assets, not a whole lot of change there. That 3 to 5% is pretty well held strong. But in more recent years, we have seen a bit of a shift from hedge funds into private equities, because hedge funds really haven't performed very well, especially when the public equity market is doing so well.
Tom, have we seen any changes or shifts in product sales and design?
Yeah, quite a bit, actually. I was referencing the arms race leading up to the crisis. Since then, the industry's done quite a bit to address that, and the product sales have shifted quite a bit. And going back to the crisis, just immediately afterwards, there was a pretty precipitous decline in life sales, also decline in individual annuity sales, particularly on the variable annuity side. So since that time, while we've seen some recovery, life sales have recovered to about the same level as they were pre-crisis. Annuity sales have not. We've seen a big shift in the mix of product on the annuity side between fixed and variable. So whereas variable was the lion's share of the sales pre-crisis, now we've shifted to fixed annuities, primarily fixed indexed annuities, which in large part have replaced the old variable annuity sale, because they've been sold largely with the guaranteed minimum withdrawal benefit riders. So consumers being a bit equity sensitive and looking for that downside protection have shifted their attention to the indexed annuities. That's got the lion's share of the attention. From a product risk perspective, it's a bit of a positive, because the reserving methodology under those riders on the indexed annuities is prone to less volatility. Under AG 33, it's a bit more conservative reserving methodology. So we see a bit less product risk for the variable annuity sales that continue. Those companies that are still active in that market and selling the secondary guarantee riders have de-risked them to a large degree, reduced the attractiveness of the benefits associated with them, which has also contributed to the decline in sales. We mentioned long-term care as well. Leading up to the crisis, a lot of players were still in the market at that time. Since that time, a lot of companies have exited the market, and there's been a precipitous decline in long-term care sales. And for the companies that remain in it, they have de-risked their products substantially. On the life side, we've seen also a big shift away from the old no-lapse guarantee universal life products, more toward the indexed universal life products, so that that indexed attraction has extended into the life market, and the no-lapse universal life sales have declined as a result. And those that remain in that market, we've seen much less generous benefits, higher premiums associated with the no-lapse UL products. So really kind of across the board, you've seen a decline in product risk, both on an in-force basis as well as on a new business basis. And on top of that, of course, being as we're in this low interest rate environment for an extended period of time, since the crisis, we've seen a big reduction in the guaranteed minimum interest rates associated with fixed annuities, as well as interest-sensitive life products like universal life. So again, a lot of risk has come off the table.
From an asset liability standpoint, are insurers in a better position today to deal with a financial crisis if one were to take place?
We believe they are, John. And I would say two things, not only from an ALM standpoint, but probably also from an ERM standpoint. I think the industry's made some pretty good strides in that area. I think the valuable lesson that they learned from the crisis was having no liquidity is not a good thing. And I think a lot of companies were strong from a capital standpoint, but they really got caught from a liquidity squeeze during the crisis. Having better ALM has improved that situation a little bit for them. And I think from an ERM standpoint, the ability to do more internal capital modeling and stress testing has given them a better feel for the results of certain downturns in the economy and the impact it will have on the companies. And I think, again, the industry is just as strong from a capital standpoint, but I think from an ALM and overall ERM, they're also in a better place.
Yeah. I think on the liability side of the balance sheet as well, they're in a bit better position too. I made a lot of references to the de-risking that's gone on. In addition, we've seen the NAIC address really the disconnects associated with statutory accounting rules around variable annuities, particularly with those with secondary guarantees. And those disconnects contributed to a lot of reserve and capital volatility during equity and interest rate movements in the past. I think the changes that they're implementing are going to reduce that volatility. So if we see some equity and interest rate movements going forward, it's going to have less of an impact on the in-force books of variable annuity business. And then when you think about all the the products that were interest sensitive having lower minimum interest rate guarantees, there's been some runoff of the high interest rate guarantees off the books. We've seen companies, actively do, offer exchange programs to their clients that are in high-risk products, particularly on the VA side. So I think we've seen some of the risk come off the books, some of the volatilities come off the books, not only, driven by insurer actions, but also regulatory actions. So the combination of the two, I think, puts them in a little better position to weather a crisis going forward.
Thanks, Tom. Ken?
Thanks, John.
You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.